Regional REIT is a commercial property portfolio comprising predominantly offices and light industrial units located in the regional centres of the UK outside of London. In March, it reported full-year numbers with a record net profit of £67.4 million, up a whopping 149% year on year. Stephen Inglis is the CEO of London and Scottish Investments, the asset manager of Regional REIT. Stephen, good to talk to you. Thanks for dropping by.
You're very welcome.
Before we drill down, just give us an overview of what these numbers represented, because that net figure, as I said, was an enormous increase year on year.
Yeah, I mean, this is the culmination of 3 years hard work since we came to market in November 2015. So we buy predominantly underloved, undervalued assets and improve them and ultimately sell them or hold for longer term income. So it's kind of what we expect to see in terms of the improvement in value. Last year was an exceptional year. We did sell in the order of £150 million worth of assets. Some of that normal turnover of our assets as we finish business plans and recycle. But we did make a strategic decision to sell some industrial assets at what is now proven to be top of the market. So we got our timing absolutely right. And that generated 80 million of that 150 million of sales and a profit of 25% over book value on those assets. But we averaged 20% over book value year on year. So looks to me as if our NAV is undervalued.
NAV, net asset value. This appears in the top line of your results. Talk to us a little bit about that and the way investors should interpret that against the numbers, bearing in mind that you are a real estate investment trust. Why a REIT first of all, and just connect that up to net asset value?
Yeah, I mean, REIT, a real estate investment trust is there to produce an income and a tax efficient income for its investors. So the main reason for investing in a REIT is exactly that. The end investor is a tax benefit or a tax beneficial position. The returns, well, the returns are made up of income and capital. So we produced a 16.6 pence per share return last year. 8% of that in income, and the other 8% in capital, a combination of valuation improvement and the sale proceeds, the profit on those sales mentioned earlier.
Yeah, let's take a couple of questions if I can from clients. We've got some wanting to hear about the cost of the debt against income.
Yeah.
How's this represented?
So we've spent 3 years working through our debt package. All of our debt is either fixed or capped, therefore no interest rate risk for us. Cost of debt, well, the cost of debt for us is about 3.5%. against the yield in terms of income yield on our assets in excess of 8%. So the arbitrage between the 3.5 and 8 is effectively a profit.
Yeah, on the debt point, if interest rates were to go up, which some are suggesting they could if and when Brexit is resolved, I want to get on to Brexit in just a minute with regard to business, but I guess that puts you in a pretty good position.
Very strong position. So our average weighted length of our debt, 8 years. So for 8 years we have no interest rate risk.
Yeah. One other question is, how do you generate the 7.8% yield and what the risks are to the yield that you're presenting to investors?
Yeah, so the 7.8% yield is ultimately income. So that is the income of the property assets we own, the rents that we collect, net of obviously the debt. So that's effectively how we do it. So it's as simple as that. So the roughly 8% income return is a net income return after paying debt.
And what do you regard as the risks to that? If anybody's wanting to buy in now, obviously there's no guarantee on future returns at those levels.
The risks are a fewfold. So risks in any property company is that your tenants, for whatever reason, don't pay rent. They either go into CVA, they go bust, or they move. Our retention rate is 75%, and that has been the case over the last few years. Therefore, we've demonstrated that our income is very robust. Our average lease length is 10 years with a 5-year break, so 3.5 years term certain, but with that renewal rate, it is very much a sustainable income position. Next risk is debt, of course. So capital values and properties rise and fall with the markets, something we can't control. We can very much control income, but we can't control capital values. So if your capital values were to fall dramatically, then, and it would have to be a catastrophic fall in our case, then you could come under some pressure from banks in terms of your debt. Our loan to value is 38.3% at the end of the last financial year. Our debt covenants are set at 60%. So what that effectively means is the markets could crash by over 30% and we'd be under no pressure.
Right, okay.
And we think that's a highly unlikely scenario.
Absolutely. Let's just pick up on one of those points and talk about the client base. Sector-wise, size-wise, what is the spread that you've got?
So Regional REIT has 150 assets, so geographically spread across the country, out with, as you mentioned earlier in your introduction, London, the southeast. In terms of the M25, we do have substantial holdings in the office market in the southeast, but we are very geographically spread. We have 874 tenants, so that's 874 income streams, and that means that we are very risk averse in terms of that diversification. Worth saying as well, we spend a lot of time looking at standard industrial classifications, and that's very much looking at where the income is derived from our occupiers. Our occupiers are all sorts of occupiers, from major high street banks to industrial companies, all very good covenants, but nonetheless we like to see a very wide spread of uses because that predetermines the risk profile of our income.
Yeah. Mindful of the backdrop economically, what do you suggest is the outlook for your client base? I mean, are you fairly happy, or do you think, there are risks down the road that you are beginning to prepare for? Yeah,
I mean, again, you have to prepare for the unexpected, and the only way you can do that is by diversification. So the vast majority of our tenants derive their income from the UK. They're UK-focused businesses as opposed to European-focused businesses. That doesn't mean to say they're not going to be impacted by certain things that happen in Europe and the rest of the world, but less so than the majority. So that kind of defends, or is a defensive strategy in some way, but it's just another way to look at it. In terms of what the occupiers are doing, we see little or no change. We have a situation whereby the whole Brexit scenario has been dragging on for so long that companies have to make business decisions. They can't just stagnate. So they are making decisions, they are signing up for new leases, and they're taking more space. And in a climate where employment's as high as any of us can ever remember, then people need to work somewhere. And that, in our view, is offices and industrial space. We don't invest in retail, as you know. So
far as Brexit is concerned, with regard Regional REIT, are you best places you can possibly be, or are there other things to do? We're hearing now about this delay potentially until October. Does that change anything?
Yeah, I don't think so. I think our strategy has been diversification. So risk diversification by, as I mentioned earlier, geographic spread of tenants, spread of uses. And I think that's all you can do to try and defend against an unknown, an unquantifiable position from whatever happens with Brexit.
Are you pleased you're not based in any way, shape or form in terms of overseas assets because of Brexit, or does it not make a difference?
Well, we're a UK REIT and we focus on doing what we are experts in doing, which is investing in UK real estate. We don't like the risk profile either of the currency risk or indeed the different legal dynamics and dynamics on leases. Very different.
Let's just take a look at share price if we can in the context of what we've been talking about. You say you came to the market, 2015 I think it was?
Yeah, November 2015.
Yeah. Here we have share price going back to just before the beginning of 2017. I want to include this area here because I think it's interesting to note that we've just hit highs not seen since, May 2017, so 2-year highs at the moment, 105.9 pence. What do you tell investors about the share price at the moment in the context of where you are, and indeed the full year numbers you produce at the end of March?
Yeah, I think share price has to also reflect NAV. So the net asset value of the company has grown substantially. So the net asset value of the company is currently 115.5. So we're still trading at a substantial discount, in my view, to NAV. So an 8% discount, which is roughly where we are as at today, that looks an unjust valuation of our company. It looks too low.
Yeah. Let's wrap it all up, bring it all together, and talk a little bit about what's in your in-tray at the moment in terms of the next half of 2019.
Sure. I mean, we've got a huge pipeline of potential deals. We have some capital to deploy from the profits made from last year's sales. And it's business as usual. Our main focus of our business is asset management. We're asset managing those properties that we hold to maximize shareholder returns. So that will be the focus. We will be buying and selling and recycling proceeds, as we always do. But it is very much business as usual for us.
Okay, well, good luck, and let's see how things develop for the rest of the year. But in the meantime, thanks indeed for joining us. That's Stephen Inglis. He's the Chief Executive Officer of London and Scottish Investments, which is the asset manager of Regional REIT.